There are periods when institutions adjust, and there are periods when they respond, but there are also periods when nothing appears to respond to anything, and yet multiple processes continue to move at the same time across central banks, regulatory agencies, treasury departments, and clearing institutions, not in reaction, not in coordination, not toward an event, simply in parallel across trading floors, policy committees, and financial infrastructure systems. In such periods, change does not concentrate in one place. It distributes across administrative surfaces inside financial institutions and supervisory bodies. Liquidity facilities extend at central banks. Capital ratios recalibrate inside commercial banks. Reporting frameworks update within regulatory filings. Settlement protocols refine inside clearinghouses. Risk models incorporate new assumptions on institutional risk dashboards. Each process moves independently, each remains procedural, each continues within its own mandate inside boardrooms, compliance departments, and treasury offices. And yet from a distance, across financial districts and policy headquarters, they appear to move together. Not because they were instructed to, not because something is approaching, but because they operate inside the same environment shaped by interest rate policy, bond markets, and funding conditions. When conditions persist long enough in sovereign debt markets and interbank funding markets, processes begin to reflect that persistence. A funding framework adjusts its eligibility terms within central bank collateral windows. A supervisory guideline updates its interpretive language inside regulatory bulletins. A clearinghouse modifies margin thresholds across derivatives markets. A treasury desk alters duration exposure along government bond curves. A regulatory body revises disclosure templates within quarterly filings. None of these adjustments require a central directive. They are not synchronized by announcement from monetary policy committees. They are not coordinated through an event. They simply operate within the same field of constraint defined by funding spreads, capital requirements, and liquidity ratios. When that field shifts gradually, processes adapt gradually. And when multiple processes adapt gradually across the financial system, their motion appears aligned. But alignment is not the same as coordination. It is not an agreement between institutions. It is not preparation. It is not convergence toward outcome. It is parallel adjustment within shared conditions shaped by macro liquidity, credit spreads, and supervisory oversight. Financial institutions rarely operate in isolation. Funding markets interface with capital rules. Capital rules reference liquidity coverage ratios. Liquidity standards intersect with settlement mechanisms in clearing systems. Settlement mechanisms depend on collateral frameworks tied to sovereign bonds and high-quality liquid assets. Collateral frameworks reference valuation models connected to interest rate curves and volatility metrics. Each system contains its own internal logic, and those logics overlap at structural points across the financial architecture. When one domain adapts to persistent conditions in funding markets, adjacent domains often incorporate similar persistence. Not because they must, but because their inputs, bond yields, liquidity flows, and capital buffers are shared. If volatility remains subdued across equity indices and bond markets, risk buffers recalibrate. If volatility remains elevated in credit markets, buffer assumptions adjust differently. If policy rates remain stable, duration models absorb stability. If policy rates remain variable, exposure limits incorporate variability across treasury desks and risk committees. Each decision is technical, each adjustment procedural, and yet the overall effect becomes visible across multiple layers of the financial sector, from data terminals to compliance dashboards. It can appear coordinated, but it is mechanical. Parallel movement does not require shared intent. It requires shared constraint across markets, policy, and regulation. When regulatory reporting cycles shorten, funding desks adapt their internal metrics. When collateral haircuts change slightly within repo markets, margin calculations incorporate those shifts. When supervisory language clarifies interpretive scope inside policy statements, risk committees revise documentation frameworks. None of these actions require dramatic explanation. They occur within operating mandates inside banks, clearing institutions, and regulatory agencies. In periods of persistent environment shaped by stable policy rates and steady liquidity provision, mandates do not need to be rewritten. They only need to be interpreted consistently. Consistency across systems produces similarity. Similarity produces parallel motion across financial institutions and supervisory bodies, but parallel motion does not signal acceleration. It does not imply culmination. It does not point toward a threshold. It reflects continuity inside the financial system. When environments stabilize across bond markets and funding markets, institutions refine their assumptions. When environments persist, institutions embed those assumptions into capital frameworks, liquidity buffers, and operational risk models. Embedding occurs at different speeds. A reporting template may update in weeks. A capital framework may adjust in quarters. A supervisory interpretation may evolve over years. Different timelines, different surfaces across the financial architecture. But the direction of motion, even when small, often shares the same orientation within institutional systems. Not upward, not downward, but towards structural coherence inside financial governance. Coherence does not require announcement from a central bank podium. It emerges from repeated interaction across markets and regulatory systems. When institutions operate within the same macro conditions long enough, their internal processes absorb similar patterns reflected in bond yields, liquidity flows, and funding spreads. Liquidity desks extend tenors cautiously. Compliance teams formalize interpretive notes. Treasury functions standardize issuance pacing. Clearing systems refine collateral eligibility across derivatives markets. Each change appears incremental, none demand attention, but together they create an environment in which operations across banks, regulators, and clearing institutions feel aligned. Alignment in this sense is not strategic. It is not negotiated at policy summits. It is not directed through coordinated statements. It is procedural. Parallel processes often appear during transitional moments in financial markets, but they also appear during extended continuity in monetary policy environments. In extended continuity, systems stop waiting for reversion in rate cycles or liquidity conditions. They stop assuming temporary funding stress. They begin incorporating persistence into capital models, reporting structures, and liquidity frameworks. When that incorporation spreads across domains, from central banks to commercial banks to clearinghouses, movement becomes visible at multiple levels of the financial sector. Capital buffers remain slightly elevated. Liquidity access windows remain slightly open. Risk limits remain slightly conservative. Disclosure language remains slightly cautious, not because of escalation, but because of duration. Duration shapes interpretation across institutions. Interpretation shapes procedure within regulatory frameworks. Procedure shapes structure inside financial systems. When structures across institutions respond to duration in similar ways, they appear synchronized across markets and supervisory bodies. But synchronization here is not an event. It is an outcome of shared adaptation to persistent market conditions. Shared adaptation does not imply shared messaging. Often, institutions adjust quietly within headquarters, regulatory offices, and boardrooms. Policy documentation updates without emphasis. Operational memos circulate without public framing. Supervisory notes clarify without announcement. These are not signals of secrecy. They are expressions of administrative rhythm inside the financial system. Institutions operate continuously, processes refine continuously. When multiple refinements occur within the same broad environment defined by funding conditions and rate policy, their trajectories resemble one another. Resemblance is not coordination. It is pattern formation within financial infrastructure. Patterns form when systems absorb the same inputs over time: interest rates, liquidity levels, capital requirements. If funding conditions remain tight but stable, liquidity frameworks adjust accordingly. If funding conditions remain loose but monitored, collateral eligibility adapts gradually. If regulatory posture remains steady, compliance architecture evolves steadily. No urgency is required, no pivot is necessary. Parallel movement can occur within stability across financial markets. In fact, stability often allows parallel refinement to proceed unnoticed across trading floors, regulatory offices, and treasury departments. During volatility, attention concentrates on market screens and policy announcements. During continuity, attention disperses. Dispersed attention allows incremental alignment across domains of the financial system. When institutional processes move in parallel, it does not mean they are preparing for something. It does not mean something is imminent in markets. It does not mean convergence is accelerating. It means adaptation is distributed across banks, regulators, and clearing institutions. Distributed adaptation produces a quiet coherence across the financial architecture. Coherence across systems does not require central orchestration. It emerges from consistent interpretation of shared market conditions. Financial institutions reference similar benchmarks. Supervisory bodies monitor similar indicators. Treasury desks price against similar curves. Clearing systems evaluate similar exposures across derivatives and repo markets. Shared reference points produce overlapping adjustments. When benchmarks persist, policy rates, yield curves, and liquidity metrics, adjustments persist. When adjustments persist across domains, they begin to look unified. But unity is an appearance. Operationally, each system continues fulfilling its mandate inside financial institutions. There is no grand shift, no transition declared, no phase introduced, just incremental refinement across adjacent structures within the financial sector. In many cases, processes move in parallel simply because their timelines overlap. A capital review cycle concludes as a reporting framework updates. A liquidity facility extends as a supervisory clarification circulates. A risk dashboard incorporates new metrics as collateral parameters adjust. None of these actions depend on one another directly, yet they occupy the same horizon across financial institutions. Horizon overlap creates the impression of alignment, but impression is not instruction. Institutions rarely require synchronized motion. They require internal consistency across capital, liquidity, and reporting frameworks. When consistency is achieved within separate domains, the broader financial landscape reflects that consistency. It can seem cohesive, but cohesion does not imply direction. It implies steadiness. Parallel processes are not dramatic. They do not produce headlines on financial news networks. They do not culminate in singular outcomes. They simply continue. When viewed over time, parallel refinement stabilizes operating norms within banks, regulators, and clearing systems. What was provisional becomes routine. What was extended becomes assumed. What was clarified becomes embedded. Not because systems agreed, but because systems adapted in proximity within the financial sector. Proximity of constraint, funding markets, rate policy, capital rules leads to proximity of response. That proximity can appear intentional, but often it is mechanical. Each institution adjusts to its own data. Yet data environments overlap across markets. Shared environments produce shared interpretations. Shared interpretations produce comparable procedural changes. Comparable procedural changes create parallel movement across financial institutions. Parallel movement does not demand attention. It does not demand resolution. It does not indicate culmination. It indicates that systems remain responsive within persistent market conditions. Responsiveness distributed across domains becomes visible only when viewed collectively. Individually, each refinement is small. Collectively, they form a pattern across the financial system. That pattern does not point forward. It reflects present continuity. When institutional processes move in parallel across banks, regulators, central banks, and clearing institutions, nothing necessarily accelerates, nothing necessarily resolves, nothing necessarily shifts phase. The environment continues, and within it, administrative frameworks across the financial sector continue refining themselves independently, consistently, and in parallel. Nothing needs to occur next. Everything already continues.